This is part 2 of my Tesla stock analysis, and if you're interested in watching part 1 where I talk more about Tesla, its growth and its competitive advantages, you can find the link to part 1 in the description below. With that said, let's get to part 2 of the analysis. Turning to profitability, perhaps one of the biggest competitive advantages that Tesla has over competitors is its level of profitability. So in 2022, the company generated $20.9 billion in gross profit at a 26% margin, and in Q1, $1.6 billion gross profit at a 19% gross margin. So margins have been going down over the last few quarters, and this is due to lower average selling prices, high inflation, production suspension in Shanghai, as well as inefficiencies in Gigafactory Berlin and Texas. But if we zoom out, Tesla's gross margin is still trending upwards, and that shows economies of scale and increased earnings potential for the company. Despite the recent downtrend, Tesla has superior gross margin profiles than all of the mass car producers. Here you can see the top 8 car producers by market cap, and it shows that Tesla has the best gross margins in the business. The higher gross margins enables Tesla to cut prices, which could significantly increase market share in terms of the number of vehicles sold. So revenue per car, or average selling price, was $47,000 in Q1. The cost per car was $37,000, which makes a 21% gross profit margin per car. So average selling prices has been trending downwards as the company cut prices to make EVs more affordable, which is pretty much its main goal. But notice that cost of revenue per car delivered is also trending downwards. So in other words, Tesla is maintaining strong margins even with the lower prices. And during the Q1 earnings call, Elon talked more about why the company is dropping prices of its cars. So the company reduced prices considerably in Q1. The company is taking the view that pushing for higher volumes and a larger fleet is the right choice here versus a lower volume and higher margin. And Elon thinks that it's better to ship a large number of cars at a lower margin and subsequently harvest that margin in the future as we perfect autonomy. In other words, Tesla is sacrificing margins today so it can grow its fleet and grow market share. So in the future, it can collect high margin revenue through FSD. Moving on, we can see how gross margins look like for each of its operating segments. So automotive margins, as you can see here, has been trending downwards because of the price cuts, but it is still above 20%, which is within management's target. Gross margin for the energy and storage business was 11% in Q1, which is an improvement from negative 12% last year as the business unit scales further. So that's really good to see. Services and other gross margin was 7% in Q1. Gross margin in this segment has been improving as the segment achieves economies of scale through a larger Tesla fleet. Operating profit in 2022 was $13.7 billion, which is a 17% operating margin. In Q1, it was $2.7 billion in operating profit at an 11% operating margin. So similar to what we've seen with gross margins, operating margins have been trending downwards due to lower ASPs, high inflation, higher cost of production ramp of 4680 battery cells, and lower credit revenue. Tesla is pretty aggressive with its expansion plan, and that's why margins are under pressure. Nevertheless, operating margins should improve in the long term as Tesla gains operating leverage. Again, Tesla has superior operating margins compared to competitors with 16.81% operating margin in 2022, which is way higher than its competitors right here. And finally, net income. Net income was $12.6 billion in 2022, which is a 15% net margin. Compared to competitors, Tesla has very little debt, which means lower interest expenses and ultimately high earnings for investors. So again, here you can see that Tesla has the highest net income margin among competitors. So fundamentally, Tesla has superior profitability, and that enables the company to cut prices as well as reinvest profits into growth. As the company scales further, we should see profitability continue to improve as the company achieves operating leverage. And that is the financial competitive advantage that Tesla has over competitors. Turning to the balance sheet, Tesla has cash and short-term investments of $22.4 billion and total debt of about $5.6 billion as of Q1, which makes its net cash position to be about $16.8 billion. So for comparison, Toyota Motors and Ford have a net debt position of more than $100 billion each, which limits their potential to grow. Tesla also has a current ratio of 1.6 times, which is relatively liquid and slightly higher than the auto industry. Unlike most pure EV companies, Tesla is already cash flow positive. So in this chart, you can see that in 2022, Tesla has a free cash flow of $7.6 billion, whereas Rivian and Lucid, they both has negative 3.3 billion and negative 6.4 billion in free cash flow. So when people say that smaller EV competitors like Lucid or Rivian are going to take down Tesla, they clearly don't understand the fact that some of these smaller players are facing bankruptcy risks. On the other hand, Tesla is reinvesting back its profits for expansion, to pay down debt, or to buy back shares. As a matter of fact, Tesla has been paying down its debt over the last few years, dropping down from about $15 billion in 2020 to just $5.6 billion in the latest quarter. So as you can see here, Tesla generated $7.6 billion in free cash flow at a 9% free cash flow margin. In Q1 though, the company generated $0.4 billion in free cash flow at a 2% free cash flow margin. So free cash flow margins did drop to 2% in Q1 from 12% last year, so investors should keep an eye out for cash flow in the coming quarters. So all in all, Tesla has one of, if not the best balance sheet in the auto industry. It's also highly free cash flow positive, which allows the company to reinvest its profits. In terms of outlook, Tesla does not provide quarterly or annual revenue and earnings guidance. However, management does provide the following targets. So for 2023, the company expects to remain ahead of the long-term 50% CAGR with around 1.8 million cars for the year. So Q1 average selling price was about $47,000 per car, and if we assume an ASP of about $48,000 for 2023, 1.8 million cars sold is going to translate to $86.4 billion worth of auto revenue, which is about a 21% increase year over year. Adding the fast-growing energy generation and storage business and services and other segment, revenue could easily surpass $100 billion in 2023. So if we head on to Seeking Alpha, we can see that analysts expect $100.38 billion in revenue for Tesla in 2023, which is a 23.2% year-over-year growth. So here we can see Tesla's revenue surprise. And based on historical data, Tesla's results has been quite in line with expectations, with more beats than misses. So we could expect Tesla to perform in line with expectations or maybe slightly higher than analyst estimates. Perhaps $102 billion of revenue in 2023 is a reasonable figure. Furthermore, on March 1st this year, Tesla unveiled its Master Plan 3, laying out the steps necessary to make sustainable energy for all of Earth. Tesla estimated that it will take $10 trillion in investments to realize this dream. The question is, could this be the plan that takes Tesla to a $10 trillion market cap? Well, I don't have the answer to that, but I do know that Tesla is on a mission to accelerate the transition to sustainable energy, and buying Tesla stock means you're supporting Tesla to achieve this seemingly impossible feat, and I think that is something to be excited about. Tesla has disrupted the auto industry, and now the company is targeting other legacy industries that could be electrified. Whatever it is, Tesla is set to execute its Master Plan 3, which is to make sustainable energy for all of Earth. That means to fully electrify the world by completely eliminating fossil fuels. This is achieved by repowering the existing grid with renewables, switching to electric vehicles, switching to heat pumps, electrifying high temperature heat delivery and hydrogen production, and switching to sustainably fueled planes and boats. So what I'm getting from this slide of the investor presentation is that we can expect new revenue streams from these three new categories at some point in the future. The long-term outlook for Tesla looks bright as the company continues to accelerate the world's transition to a sustainable economy. So turning to the valuation of the company, Tesla's share price has gone through a roller coaster ride over the last few years. At the November 2021 peak, Tesla's share price reached $400 a share, which represents a $1.2 trillion market cap. But then Tesla plunged more than 75% from its high. Insider selling, Twitter distraction, growth stock sell-off, high inflation, and interest rate hikes were some of the reasons why the stock collapsed. And Q1 earnings came out and the stock dropped like a rock. But the question is it still worth investing at the current price of $160 a share? So looking at Tesla's valuation multiples, the stock seemed to be trading cheaply based on historical standards. As you can see, Tesla's EV to revenue multiple has gone through the roof in 2021, reaching a multiple of 25 times. Since then, valuation multiples have gone down significantly to just 6.8 times. So if we head on to Seeking Alpha again, we can see Tesla's valuation compared to its peers. So as you can see, Tesla's EV to sales multiple is way higher than all of its peers, excluding Ferrari. Tesla's PE ratio is also many multiples higher than its peers. So comparing its valuation to its peers, Tesla's valuation looks really overvalued in my opinion. But again, this is due to the fact that Tesla has higher revenue growth rates as well as superior profitability compared to peers. And in terms of analyst price target, they have an average price target of $195 per share, which is a 20% upside, with a low of $85 per share and a high of $300 per share. And as a sanity check to analyst price targets as well as the current prices set by the markets, I also did a DCF analysis of my own. So here is my DCF model and here are my key assumptions. So for revenue growth, I followed analyst estimates in the first 3 years and then gradually drop it to 11%. For cost of revenue as a percentage of revenue, I expect that to increase in 2023 to 78% as compared to 74.4% in 2022. And this is primarily due to the company dropping prices as well as high inflation. However, I do expect cost of revenue as a percentage of revenue to go down as the years go by and as the company achieves economies of scale. For operating expense, I do expect the company to gain operating leverage, dropping from 8.8% all the way down to 7% by the end of 2032. Income tax will eventually grow to 20% of operating income. Depreciation and amortization dropping to 3.2%. Stock-based compensation will stay stable at 1.5%. Capital expenditures, on the other hand, is expected to be $6 to $8 billion in 2023 and $7 to $9 billion in the following 2 years as guided by management in the beginning of this year. And changes for net working capital, I'm going to stick it at about 1% for my projections. So based on these assumptions, I do get a gross profit margin of about 30% as the company achieves economies of scale and enjoys higher margins from software-related products such as FSD. However, this will be offset by lower average selling price. For operating margin, I do expect the company to achieve operating margins of 23% by 2032. With all that, I arrive at a free cash flow margin of 18.1% by the end of 2032. For context, this is higher than BMW's free cash flow margin of about 10%, but this is lower than Apple's free cash flow margin of about 28%. So assuming a perpetual growth rate of 2.5% and a discount rate of 10%, we arrive at an intrinsic value per share of $204 per share. This is slightly higher than the analyst's average price target of $195. Nonetheless, the current price of $163 per share shows that the company is undervalued. However, for growth stocks, I usually use a wide margin of safety of at least 50%, but given Tesla's durable competitive advantages and some of its growth potential, I like to use a lower margin of safety of about 30%. So if we use a preferred margin of safety of 30%, I arrive at a margin of safety price of $143 per share. So while the company is trading below my intrinsic value per share of $204, I do want a larger margin of safety, and this is where I will start buying the stock. And if the stock goes down to new lows or below $100, I'll be buying it very aggressively. With that said, here's an interesting observation. So Master Plan 1 was published in 2006, and 10 years later, on the day that Tesla revealed Master Plan 2 on July 2016, Tesla's market cap reached $33.8 billion. And ever since Master Plan 2 was revealed on 20 July 2016, its market cap surged more than 3,000%, and as of this video, Tesla's market cap reached $515 billion, which is a 15-fold increase since 2016. So Master Plan 3 was revealed on March 1st this year, and if Elon delivers once again, we could see another 1,000% to 2,000% increase in the stock, and this will blow past the $10 trillion mark. And this will be a long and difficult road for sure, but I believe Tesla has what it takes to achieve this milestone. Even Elon thinks that Tesla could be worth more than Apple and Saudi Aramco combined. So turning to the risks of the company, I think competition is by far the biggest bear argument against Tesla. All this competition could take market share from Tesla as well as put pressure on margins. I mean, we're talking about Chinese rivals like BYD, NIO, and XPeng. We're talking about smaller EV players like Lucid, Rivian, and Polestar. We're talking about legacy automakers like Ford, Mercedes, and Volkswagen, and even tech giants like Apple are also planning to enter the EV market. So these are threats worth considering. So another risk would be the price cuts. As you can see, here are some of the recent headlines as Tesla cut prices of its cars globally. Analysts are pretty mixed as to whether these cuts were a sign of weak demand or Tesla just being aggressive in taking market share. Whatever it is, investors may not like the fact that Tesla's margin profile may worsen due to these price cuts. And finally, another risk is cannibalization. So if the cost of hailing a Tesla robotaxi is low enough, and if it's really convenient for people to access these robotaxis, the need to purchase Tesla cars or the need to purchase another car is going to significantly reduce. As such, the development of robotaxis will actually reduce Tesla vehicle deliveries. So according to ARK Invest, global auto sales may decline as robotaxis hit the road. As shown in this chart, ARK Invest expects unit volumes to be 29 million units lower than consensus expectation for 2027. In other words, this could hurt Tesla vehicle sales. So to wrap up this video, I think Tesla is one of the most controversial stock out there, but I do think Tesla is a really great company to own in your portfolio. Tesla is the top dog in the EV industry and it has a long growth runway because of megatrends such as EVs, solar, renewable energy, autonomous driving, robotaxis, and so on. Tesla also has technology, brand, scale, and cost advantages moats, and this will not only support its growth ambitions but also protect it from competitive threats. Tesla has a strong balance sheet, cash flow, and management, and with Master Plan 3 in place, we could see Tesla being a $10 trillion company one day. But after looking at Q1 results, there are things that we should worry about, including worsening margins as well as slowing auto revenue growth. With that said, Tesla stock is very close to my margin of safety price, so I'll be keeping a close eye on the stock. But what about you? What do you think of Tesla stock? And also, if there's a company that you want me to cover in this channel, please let me know in the comment section below. With that said, thank you guys so much for watching this video. If you find value in this video, please hit the like button and subscribe to my channel so you won't miss future videos. Thank you, and I'll see you guys on the next video.